Something is wrong with silver. Not the headlines, not the YouTube thumbnails, not the story, the math. Because silver is not just a metal, it's not just a hedge, and it's definitely not just gold's little brother. Silver is a monetary asset, distinguished, disguised as an industrial input, priced like it's abundant, while being consumed like it's scarce. And when those two realities collide, they don't just whisper, they explode. Gold sits in vaults, silver disappears, and that's the difference. According to the Silver Institute, more than half of annual silver demand comes from industry, solar panels, EVs, the grid, electronics, medical devices, military tech. Solar alone has become one of the fastest growing sources of demand. The world is electrifying. Silver is the most conductive metal for electric on Earth. And unlike gold, which is hoarded, silver is used, dissipated, recycled inefficiently, or lost in microscopic layers across billions of devices. Gold stockpiles accumulate, silver stockpiles shrink. That's not an opinion, that's physics. Most people think silver miners mine silver. They do not. Roughly 70% of silver production comes as a byproduct from mining copper, zinc, and lead. That means silver supply does not respond cleanly to higher prices. It responds to base metal economics. If global growth slows and copper production slows, silver supply can contract, even if silver demand rises. That's structural. That is not cyclical. And it means the supply curve is far less flexible than people assume. Now, we need to talk about something uncomfortable. The price of silver is not set primarily by people taking delivery of bars. It is set in the futures markets, contracts, leverage, paper. On exchanges like the COMEX, silver trades in quantities that dwarf the amount of physical metal available for delivery. That does not automatically mean manipulation, but it does mean this. Price discovery happens in a market where most participants never intend to touch the metal. They roll contracts, they hedge exposure, they arbitrage spreads. The question isn't whether that system works in normal conditions. The question is, what happens when it doesn't? What happens when physical demand overwhelms available inventory? What happens when industrial users can't source what they need? What happens when investment demand spikes at the same time solar demand is hitting records? It's not a conspiracy theory. It's a stress test. Over the last several years, visible silver inventories in major exchanges have experienced significant drawdowns during periods of strong demand. When registered silver inventory falls, meaning metal actually available for delivery, the cushion thins. And thin cushions don't absorb shocks, they transmit them. We saw something similar in nickel in 2022 on the London Metals Exchange. Different metal, different dynamics, same lesson. When physical supply and paper positioning diverge too far, volatility is not gradual, it is violent. Historically, silver has traded at a fraction of gold's price. For centuries, the ratio hovered between 12 to 1 and 20 to 1. In modern times, it's been far higher. When the ratio stretches to extremes, silver has historically outperformed gold during reversion phases. If gold is repricing due to monetary stress, silver does not move politely, it accelerates. it compresses the ratio. It overshoots. That's not guaranteed, but it has happened, and repeatedly. And markets have memory. Here's the core tension. Silver has two identities. First, monetary metal. Second, industrial necessity. If we enter a monetary instability cycle, debt stress, currency debasement, loss of confidence, silver benefits. If we enter an aggressive electrification of solar expansion cycle, silver again benefits. It does not need both, it just needs one. And right now, both forces are present. Global debt is at record highs. Central banks have expanded balance sheets dramatically since 2008. Meanwhile, solar installations are accelerating globally, and each panel requires silver paste. It's not a narrative, it's arithmetic. The push forward towards renewables has quietly transformed silver demand. Every photovoltaic cell contains silver. Thrifting, or reducing silver content per panel, has occurred, but volume growth has outpaced thrift gains, meaning total silver demand from solar alone has grown materially over the past decade. The world wants electrification. Silver is embedded in that future. And there is no scalable substitute with equal conductivity and durability at similar performance levels. It's just engineering reality. Silver's market is small, tiny compared to gold, microscopic compared to global bond markets. That means small shifts in capital flows can have outsized price impact. If even a fraction of institutional portfolios allocate modestly to physical silver or silver ETFs, the supply-demand balance can tighten rapidly. In previous bull phases, silver didn't climb smoothly. It surged, it doubled, it tripled. Then it corrected brutally. Volatility isn't a bug in silver, it's the feature. Let's be clear, silver is not a guaranteed moonshot. It is volatile. It can underperform gold for extended periods. Industrial slowdowns can weaken demand. Speculative froth can create blow-off tops. And futures markets can suppress price momentum longer than physical holders expect. But risks cut both ways. The greater structural risk may not be that silver collapses. It may be that silver reprices faster than supply chains can adjust. And when industrial buyers panic, they don't negotiate, they secure at any price necessary. In 1933, the U.S. government made it illegal for citizens to own gold under Executive Order 6102. But silver was treated differently and later nationalized under separate legislation. The point is not that confiscation is imminent. The point is that monetary metals become politically relevant during stress cycles. When trust erodes, governments intervene. And silver sits in a strange gray zone. Too monetary to ignore, too industrial to disrupt recklessly. That makes it strategically sensitive. Annual global silver mine supply, roughly 800 to 900 million ounces. Global financial assets, hundreds of trillions of dollars. Even if a tiny reallocation, say 0.5%, even 1%, seeks exposure to physical silver, the available float tightens fast. And because silver is consumed industrially, not just hoarded, replacement supply is not instantly available. That's the asymmetry. Downside is volatility. Upside is convexity. Silver is not about hype. It's about tension between paper and physical. Say that again. Between paper and physical. Between industrial consumption and monetary hedging, between supply constraints and demand acceleration. Markets ignore tension until they can't. And when silver moves, it rarely asks permission. It reprices fast and violently, without warning. The question isn't whether silver is undervalued. The question is whether the current price reflects industrial necessity, monetary optionality, supply inflexibility, inventory drawdowns, and potential capital reallocation. If the answer is no, then the move won't be incremental. It will be structural. And structural repricing doesn't trend, it snaps. Silver doesn't need a story, it needs stress. And the system is full of it. Thank you for watching all the way to the end. Join us tomorrow when we examine whether they are coming for your gold and silver again. Italy, by the way, says hello. But in the meantime, take care of yourself and each other. And as always, build that stack.